Hello everyone, I'm Sidhant. Today I'm going to start the accounting and the finance for the banks for JAIIB certification exam. In this we will start the module A with the chapter 1, the calculation of interest and the annuities. First of all, I would like to have you with the pen and the pencil or the paper, because especially in the module A you have to solve numericals. All numericals will come from this section mostly, and you must have a command over the formulas or the derivations which is required to understand this chapter. So numerical is very important, especially the module A. I will also helps you to understand the formulas as well as the concepts. First we will deal with the objective part, then we will switch to the numericals. Let's start. First, introduction of interest and the annuities. Before starting, you must have known what is interest and what is annuities. Interest is something that you have heard of. The loan is at the interest of 5%, or the fixed deposit at the interest of 6%. What is that interest means? Simply, if you deposit 100 rupees, then after 1 year it is 106 rupees if it's at a 6% interest rate. 6% means 6 of 100. For every 100 rupees you will gain 6 rupees as an interest. Next, annuities. What are annuities? Since in the interest we saw that in the first year you took 100 rupees loan, then at the end of first year or at the start of the second year you have to pay 106 rupees if it's a loan. What is this 6 amount? This is interest charged. So in interest, what we are doing, we are taking something and repaying at the end of 1 year. What if someone wants to pay monthly? Because for the salaried class person, the salaried are credited monthly, so they want to deposit monthly. What will be the impact? And that impact is the study by the annuity. That is annuity. For example, let's say in the first year he took rupees 100 as a loan. Then at the end of second year, in spite of giving at the start of the second year, he started giving monthly. So in the next month he will give some amount. In the next month he will give some amount. So what will be the advantage of giving monthly? The advantage is that if you pay monthly, or we call the annuity or call the EMI, that is equity monthly installment, is one of the part of the annuity. So if you pay monthly, then you are paying some amount of principal as well. So for, let's say, for 100 rupees you are paying 8 rupees as principal for the first month and some amount of interest as well. And this amount as well as this interest is found through the formula. We will discuss later. Just have a glimpse what is this all about. You will feel it, then you will understand it. So in the first month they have to pay say 11 rupees. Then they are paying some principal amount as well as some interest amount. So if they are paying principal, so from the next month the amount of principal where the interest are charged will be less. So the total amount will get reduced. And what is the advantage of this EMI? That since they have to pay monthly, so they think that the amount are charging very less, so they are very comfortable in paying that. So there the concept of annuity comes into picture. So and our next topic is simple interest and compound interest. You will surely get either of them as one of the questions in the examination paper. So you should know what is the formula of SI, that is P into R into T by 100. You must have all known this. And what is the amount? Principal plus SI. Okay. Now for compound interest, the formula is 1 plus R by 100 and power n, that is the time, or this is not CI, this is amount. And if you want CI, then you have to subtract this from this. You will get the CI. So this is the formula you should take into. Just solve 5 questions from both of them. Then you will have a command over the formula and you will easily solve the questions. Since the interest are charged annually, if it says 6%, then it intrinsically means that 6% per annum. But in some of the questions you may be asked that you have to calculate per month. Then what will you do? If it's the case, then if 6% is given and you have to count it monthly, then you have to divide the rate with 12. The relative parameter is annually, and with that you have to find the monthly, quarterly. If it's monthly, then you have to divide with the 12. If it's quarterly, then you have to divide with the 3. And if it's biannual, then you have to multiply with the 2. That's the case. So the rate becomes 6 by 12, that is 0.5% per month. And what about the time? It's 12 times of the time given. So you should take this when the question will be asked. You should read the questions and act accordingly. Now, one concept, lots of times the one concept based on one concept the questions are asked. They will ask that yearly if some amount is charged, the amount is nothing but a principal plus some interest. What if that interest are calculated monthly? What is the impact of this amount? The amount will increases. Once you decreases the time, that is, if you decrease the time, the amount or the impact of interest on the amount will increase. So that's the case. I will give one example. For let's say if 10,000 amount is taken as a loan and 6% is the interest rate. After 1 year, how much he has to give? If it's yearly, then it's 10,600. If it's monthly, it is 10,609. If it's quarterly, it's 10,613. If it's monthly, 10,616. And if interests are charged weekly on the weekly basis, then 10,618 rupees. You are seeing that the amount is increasing when the time is decreasing. So that's the thing you should know. They will frame a theoretical question based on this. The next concept is fixed versus the floating rate. The fixed rate, you must have known that if it's a 6% this year, then the next year also they will charge the 6%. And what about floating rate? The floating rate depends on the market. The market runs on the basis of the interest rate. How much interest rate? If the amount, if they require lots of money, they will increases the interest rate. And when they don't need any money as a borrowing by the government, then they will, then the interest rate remains low as compared to the when it's demanded. So it's all depend on the government. So and if it's also depend on the person whether they want to embrace the fixed rate or the floating rate at the time of taking of the loans. So the one advantage of the floating rate that indexed with the market, once the market got changed, then the interest rate also got reflected in their loan amount. So and there is also one advantage, the fixed rate that floating rate, that the amount of interest is initially are charged more than as expected, because in order to adjust the margin they have to adjust. So they initially they increase the rate of floating rate. The floating rate are already more than what it is required at the time of taking loan. Now we will discuss the numerical part of this chapter. That is more important than the theoretical part. So in the numerical, there is only one concept in this, the annuity. The questions are framed on the basis of the annuities, but the annuities are of two types. First, the ordinary annuity, and second, the annuity due. What is this meaning? You must have known, because in the questions they will specifically say that the annuity is ordinary annuity and or the annuity is annuity due. So if it's a ordinary annuity, let's take the example of that EMI, what you are paying monthly. What generally you are doing, you are paying at the end of the month. So at the end of the month you are going to pay. That is called a ordinary annuity. What if you own for the mobile phone? At the mobile shop you have taken mobile, and they have said that they will charge the EMI, but the EMI on the basis of annuity due. What does it mean? That you have to pay at the time of taking phone, you have to pay the amount or the EMI which will be charged. So let's say if the EMI is 900 you have to give, then at the time of taking phone you have to give this EMI. But in ordinary annuity you will take the phone, then you will, after 1 month you will pay the EMI. That is the ordinary annuity, and this is annuity due. Due means you have to pay before. That is the case. This you have to remember 4 formulas. Formula every now and then, because the questions are asked on this formula only. So I will also show you the derivation, how these formula are derived. First formula, I will make a square here. You just have to write it on your notebook. This is the one formula. I told you this is nothing but a finding of the present value and the future value. So why this present value and future value are needed by the bankers? Because since you are giving loans, as we know that for loans the bank are earning profit. So from this they will find, from this formula or applying this, they will know that these loans will be profitable or not. As we know that with the inflation, the prices are rising, the value of the rupees are decreasing. So due to the inflation, this present value and future value are taken into concern in order to find that whether they are giving loans or depositing money, as customer point of view they are gaining it from it or not. So that's the purpose of this annuity. The present or future will be finded. It depends on the situation. I will give you the examples why this present value or future value is required. Let's say something in your mind that after 10 years from now I will buy a house. So you are thinking that after 10 years I will buy a 50 lakh worth of house. So how much I will deposit every month from the salary or every year from any source, so that I could buy after 10 years the 50 lakh worth of house. That is annuity. You will, from the formula you will get that monthly or yearly you will have to pay, or you will have to deposit this amount of money at this interest. You will have this amount of money at this point of time when you want to buy house. That is the concept, or that is the applications of annuity. And in this annuity we are finding the future value. We are finding nothing but a future value of something. In future you are buying something, and this accumulation for buying something in future is nothing but a sinking fund. In my JAIIB exam, these questions are asked, what is sinking fund? So you should know this future amount, whatever you are depositing to accumulate the amount in future, is called a sinking fund. This fund is generally used by the companies to buy something. Machines are depreciated. In order to remove that, this sinking fund are used. So this future value is applied by the customer in order to know something, or by the people. It's for people use. Now what is the use for the banker? Why we are learning this? Because let's say you are giving 1 lakh of loan at some amount, let's say 5%, and the EMI calculated per year or per month, you have to give some amount. So every year they are giving some amount. So whatever amount they are giving, whether all this amount collected as an EMI will give more than 1 lakh or not. If it's giving more than 1 lakh, whatever this amount, the present value of all this amount, whatever giving is more than 1 lakh, then it's a profitable loan. You should invest in that. But if it's not, if the total amount is less than 1 lakh, then you should reject that loan, because that will not be benefit for the banker's point of view. So we can reject. But in some cases, especially for the DRI cases or the recently the MSME cases, these things are not taken, because we are public sector bank. We are for the people, for the benefit of the people. So this might be curbed, but these things are taken into concern in order to give loans to the person. So this is the 4 formula which is required. This is future value, ordinary. This is future value, annuity due. This is present value, ordinary. This is present value, annuity due. I will give the trick to remember this formula. You just need to remember future value, ordinary. From this you will derive all these formulas. So if you remember, you will remember once you will derive it. I will also show you the derivation, how it will be found for getting the feel of the formula. So if you remember this formula, then this formula can be remembered. So here it is. Since future value ordinary, as we have seen the future value in ordinary, we are giving at the end of the month. We are paying at the end of the month. And since in annuity due, it is before the month, so or before the year, here we are giving at the end of the year. The payment is, or EMI or the deposit is done at the end of the year. But here in the annuity due, we are giving at the start of the year. So you will get that extra amount of interest of your amount, as you have given almost 12 months earlier as compared to the ordinary one. So you will have to multiply this. As we know that in the compound interest, we know that the formula is P1 plus R by power n. So if for 1 year 1 plus R n is equal to 1, so you will get 1 plus R. This is 1 year interest. Here also you are getting 1 year interest. So this is 1 plus you can say R. You can write R to avoid the confusion, because this is nothing but a rate, 1 plus R. So these 2 formula covered. Now the next is present value. As we know that whatever the future value, the present value is lesser as compared to the future value, because if we finding future value, then we are multiplying with 1 plus R. This is a multiplying factor. But if you are finding present value of anything, then you have to divide it with the 1 plus R. This is called a discounting factor. So since the future value is more than that present value, so here you have to divide it 1 plus R. So only 1 plus R you will divide from this present value, then you will get the present future value, you will get the present value of this ordinary due, the ordinary. And in the similarly the present value annuity due, you are getting 1 year more interest, so you have to multiply this with 1 plus R. The formula. Now I will derive how. Here the derivation. As we have read, in order to find the future value, the first year you have paid some amount, let's say P. In the second year you will pay P. Third year you will pay P. And it's a ordinary one. Future value derivation. Okay. And in the fourth year you will get P. So how much amount you will get after n years? This is the question. So in the n year, also you will pay that P amount. So this P is nothing but you will get the P. And this P, since only 1 year, for 1 year you have deposited this P, so the amount is 1 plus R R is nothing but a interest. So for this P, you will get P 1 plus R ka square. Similarly, the future value is equal to P plus P1 plus R, P1 plus R square up to P1 plus R n minus 1. Because for the third term you are getting 2, for the n term you will get n minus 1. Now the future value multiplying, if we take equation 1, now multiplying equation 1 with 1 plus R, then you will get P 1 plus R, P 1 plus R square P1 plus R cube up to P1 plus Rn. So this is equation 2. Subtracting 2 from 1, we will get future value multiplied by R is equal to P1 plus R n minus P. So future value is equal to P common 1 plus R power n minus 1 divided by R. This is nothing but the first formula that we have find is this one. So we will able to derive it, and you can also derive other formula like this way. You can do it on your own. One more trick I would like to say, because that is very important, is the handle of the calculator. How you can calculate swiftly or fastly. More often than not, you will get the equation like 625 power 1 by 4 or 1.08 power 90. You will get this type of questions very often. So in order to find the power, you should understand one trick from the calculator. Since the scientific calculator is not allowed, so you are left with only to solve this with this calculator only. So by calculating, for calculating we are taking a simple example. For example, 625 power 1 by 4. How you can calculate this using calculator? So with this, you have to first type 625, then with this square root you have to press 12 times. 1 2 3 4 5 6 7 8 9 10 11 12. From this you have to subtract 1. Okay, then you have to divide 4, then you have to add 1, you have to press equal to, then you have to do multiply equal to 12 times. 1 2 3 4 5 6 7 8 9 10 11 12. So you will get this 5.00474619, and if you do it manually, you will get 5. So out and out, this is a good method to find the power of any number. You can easily find it. So that's it. In the next question and answer session, I will take questions from each type, and I will also show you how to solve that. Then we will complete this chapter. This is a very important chapter. Lots of questions, both theoretically, numerically, are asked from this section, and also the directly formulas are also asked with the changing of the time, quarterly, monthly, that on that basis. So be focused, be prepared, you would able to do. Thank you.